Starting with chapter 15, we're getting into the entities portion of the class. From here on out, we'll pretty much look at the different types of taxable entities that are in existence in the United States and get specifically into each kind of entity. Chapter 15 is basically an overview of the different types of entities in terms of legal characteristics, non-tax characteristics, and also tax characteristics. So with learning objective 1, let's just quickly look at some non-tax characteristics and legal classifications. So there's some key facts here at the beginning of the learning objective. State law classifies entities as either corporations, limited liability companies, or LLCs, general partnerships, limited partnerships, or sole proprietorships. All right, so that's kind of the playing field, and different types of entities that we're talking about. Corps and limited liability companies shield their owners against the entity's liabilities. This is probably something you've heard of in previous accounting classes. Only the entity itself is liable for its debts. The owners are not liable for the debts of the company. However, they can lose their investment dollars, whatever they invested in the company. And then corporations are less flexible than other entities, but are generally better suited for going public. That is, being able to be owned by a pool of public investors. So this learning objective is basically just a little bit of reading, talking about the legal classification of the different types of entities. If you want to go into Connect and into the ebook, you can hover over these links right here, and it will provide you with an explanation or a definition of the term that is bolded. So you can go that route in terms of reading this information. There's non-tax characteristics. Here's more of a discussion about responsibility for liabilities, the limited liability idea I just mentioned. And then this is the rights, responsibilities, arrangements of owners. This is getting at the flexibility issues of corporations. There's a summary there in Exhibit 15.1. I think I can also quickly handle the tax classifications as well in Learning Objective 2. Typical scenarios. Corporations are taxable C corporations unless they make a valid S election. That means they can elect to be taxed as an S corporation, which we'll see what that gets them later. Unincorporated entities are taxed as partnerships if they have more than one owner. They're taxed as sole proprietorships if held by an individual, or as disregarded entities if held by some other entity. A disregarded entity basically, they wouldn't file their own, the company wouldn't file its own tax return. Instead, it would simply include all of its income and expense items on the tax return of the owning entity. Unincorporated entities may elect to be taxed as corporations. So you can read here about what this term flow-through entities means. That a term basically reserved for entities that do not get taxed as an entity. Instead, they flow their earnings through to their owners, and their owners pay the tax on whatever the income is. The discussion of C corps and S corporations right there, disregarded entities, single-member LLCs. So you can read about the different tax classifications right here. And then this example 15.1 is a good example, kind of telling you about how an entity might be able to be classified in different circumstances.